Fed kicking off a two-day policy meeting today. Let's get to Steve Leisman with exclusive results of our CNBC Fed survey. Hi, Steve.
Morning, Mike. Yeah, respondents to the CNBC Fed survey lowering their forecast for the S&P 500 for this year. The first decline in their forecast since September, and mostly attribute stock market weakness to administration policy and uncertainty. S&P now seen finishing the year at 56.75. That's 1% higher from current levels, but down about 5% from the January average forecast, and you can see breaking a string of increases. The new forecast erases the optimism for stocks seen in the wake of the election. 2026 averages at a nice number, 63.28, or 56, yeah, that's right, 63.28, or 12% from rise from the current level. 42% saying the reason for the sell-off is mostly policy uncertainty. 29% say it's not uncertainty about policy, it's the substance of policy that troubles the markets. 29%, however, pointing to higher valuations, and 15% pointing to economic weakness. John Donaldson of Haverford Trust Company writes in with the survey, the degree of policy uncertainty is unprecedented. The Fed is very model dependent, and it is very hard to model based upon moving targets. On the upside, just 56% now say stocks are significantly or somewhat overpriced. That's down from a big number, 73% in January. 19% say stocks are correctly priced. 22% even think they're underpriced. That's up from just 5% in January. Here are the Fed expectations. Nobody thinks they're going to do anything with rates tomorrow of the 32 respondents, but 77% are looking for 2 or more cuts this year, but 19% say no cuts. That's actually a pretty wide disparity. Mostly everybody's always on the same side, but between 2 and none, that's a pretty big jump there. And 36% are seeing the probability of recession. There's 36% probability put on a recession in the next 12 months. That's up from 23%, now at the highest level since September. This recession outlook, like a lot of indicators out there, it had plunged in the wake of the presidential election, but is now flashing some caution. It remains below the worst levels. We're up about 50% in 22 and 23, but it still signals, guys, a renewed worry about the outlook coming from this group. Guys?
I wonder what the track record is, Steve, in terms of those odds rising into an actual recession, or if they just flare up during periods of uncertainty.
I think it's the latter, Sarah. We had a number of 63% probability. I could tell you exactly when that was, but it was sometime in 2023. November of 22. It was 63%. It was up north of 50% the whole time from like July 22 through June of 23. So it was up there. It was elevated. It was a greater than 50% chance, and it didn't happen. So just treat it the way you do, say, a sentiment index, Sarah, which is it's showing that there's some caution. And again, this idea of uncertainty. What I think is interesting was all of the optimism that came after the election. A lot of that looks like it's gone.
Yeah, no, and earlier I showed it'll be interesting to see whether it actually has an impact on, say, the unemployment rate or some of the core jobs data, which would matter to the Fed. Thank you, Steve. Steve Leisman.